Consolidation with acquisition at carrying amount of equity. In business combinations, a parent company may acquire control over a subsidiary by purchasing its shares at an amount equal to the carrying amount of the subsidiary's equity. This situation typically occurs when the subsidiary is acquired from existing shareholders, and the book values of the subsidiary's assets and liabilities are considered representative of their actual economic values. The carrying amount, also referred to as the book value, is the value at which an asset or liability is recorded in the subsidiary's accounting books, based on historical cost and adjusted for any depreciation, amortization, or impairment. In this case, there is no revaluation to fair value at the date of acquisition, and no goodwill or bargain purchase gain is recognized in the consolidation process. The acquisition date is a critical point because it marks when the parent company obtains control over the subsidiary. Control is typically achieved when the parent owns more than 50% of the voting rights or has the power to govern the financial and operating policies of the subsidiary to obtain benefits from its activities. Upon acquisition, for consolidation purposes, several key procedures must be followed. First, the parent's investment in the subsidiary as recorded in the parent's separate financial statements must be eliminated against the subsidiary's equity balances, which typically include share capital, retained earnings, and other components of equity. This elimination ensures that the group financial statements reflect only the assets, liabilities, income, and expenses of the subsidiary, not the investment figure. Second, intercompany balances such as receivables and payables between the parent and subsidiary must be eliminated. This step prevents the inflation of group assets and liabilities, which would misrepresent the group's financial position. Third, intercompany transactions, such as sales or service transactions between the parent and subsidiary, must also be eliminated to prevent the overstatement of revenues and expenses. If the transactions involve inventories or fixed assets, any unrealized profits embedded in those items must also be eliminated. Since the acquisition occurs at carrying amounts, no goodwill is recorded on consolidation. Goodwill typically arises when the purchase price exceeds the fair value of the identifiable net assets acquired. However, because the acquisition price is based exactly on the book value, no such excess exists, and thus no intangible asset needs to be recognized. Likewise, no bargain purchase gain is recognized. A bargain purchase gain would arise if the purchase price were lower than the fair value of net assets, indicating that the buyer acquired the subsidiary at a discount. In acquisition at carrying amount, this situation does not happen. The consolidated statement of financial position will include the parent's assets and liabilities, the subsidiary's assets and liabilities at their carrying amounts, elimination of the parent's investment and the subsidiary's equity, elimination of intercompany balances and transactions. The consolidated statement of profit or loss will combine the revenues and expenses of the parent and subsidiary, after eliminating intercompany revenues and expenses. Through this method of consolidation, the group's financial statements present a complete and unified view of the financial position and performance, as if the parent and subsidiary were a single economic entity from the acquisition date onwards. It ensures transparency and avoids the duplication of results that could mislead users of financial statements. In summary, consolidation when acquisition occurs at the carrying amount emphasizes the elimination of the investment account, the combination of assets and liabilities at book value, no recognition of goodwill or bargain purchase, the elimination of all intercompany transactions and balances. Proper application of these principles is essential for accurately presenting the financial condition of the group and for complying with applicable accounting standards, such as IFRS 10, consolidated financial statements or the relevant national standards.